Thank you, everyone, for your time. I'm Karen Mansgo. I think everyone here knows me as I've been serving your relationship since you hired Wespath. But I do want to turn it
Sorry,
over
but
to my
look at that
two
door. Sorry about that.
colleagues, Miles and Connie. We always like to bring in folks from our investment team to provide an update on our funds and the work that we are doing. So I invited Connie and Miles to join us and talk a little bit about our fixed income funds and maybe the fixed income markets as well. And then also joining me is my colleague, Neil Sobchak, and Neil will talk about the equity markets as well. But I know you all met Neil in person for the last meeting. So I'll turn it over to Connie and Miles and have them give themselves an introduction. Connie, if you want to go first.
Yeah, sorry, just working on getting unmuted there, but good to see everyone. Dustin and I reconnected on the call, Karen. We did meet in Florida a couple of years ago, so good to see you again, Dustin, and nice to see everyone else on the call. I think I've met a couple of other people at some point, but I actually came back to Wespath a couple of years ago. I was gone for a few years working for Christian Brothers Investment Services. And prior to that, I was at Wespath. So I did like a round trip. And prior to that, I taught high school math in Chicago for several years. And before that, I was a fixed income portfolio manager for a couple of shops in Chicago, Brinson Partners and ABN AMRO. So leading the fixed income group with Miles at Wespath and happy to be here. Miles, do you want to give yourself an intro?
Sure. Hi, everybody. I'm Miles Smith. I've been with Wespath for about 4 years now, starting in our investment analytics team, and then roughly 2 years ago transitioned over to public markets and have been working alongside Connie and the rest of our public markets team on primarily fixed income, but also some equity stuff as well. But happy to be here.
Great. I will share my screen. Oh, can you guys see my screen? Okay, perfect. It's not showing up around my monitor, so I wasn't sure if I was sharing it or not. So let's just kind of jump right in here. We always like to put out information every quarter, and one of the things we like to put out is our quarterly investor letter, which provides information about like the markets and the funds. We also launched a new international equity index fund, which I'm going to talk a little bit about here in a moment. And then finally, the piece that we included was we did launch our sustainable investment report. And this is our report, which I like to refer to as our impact report. It kind of collectively takes in the work of our sustainable investment team over the last 15 to 18 months. And I like to say it's where we bring in Wesley into our investment approach. I mean, everyone knows that John Wesley was a social advocate and he, fought for things that he believed was not right. And this is, kind of highlights the work that we do when we engage with companies regarding their business practices that we view as being unsustainable. It also talks about our positive social purpose lending program, which is the practice of earning a risk-adjusted rate of return while simultaneously benefiting society. And this makes up a part of our fixed income portfolio, which is included in your balanced fund and also your fixed income fund. Dustin, one thing to keep in mind is that there are a few foundation partners that ask for us to make hard copies of this presentation for them that they bring to like client presentations, maybe that you and Tyler are doing. Just kind of shows that impact report. Always happy to send you copies, just something to think about as you meet with churches.
Thank you.
And then there's a few blogs that we wrote. One was understanding the outperformance of the U.S. and why we believe having global exposure in equities is important. So my colleague John Morris and then Joe Hallwax, who you all might have met, who leads the group that Neil and I are a part of, wrote this article. And then we also wrote about our International Equity Index Fund. I know we talked a little bit about this fund when we met in August. So now the fund is launched, and I have a slide or two in the presentation that I'll kind of cover that talks about it. Any questions about Wespath before we move on? Okay, great. So looking at your accounts, this is a summary as of September 30th. You can see all of your investments at Wespath total about $74.8 million. And I'll go through each of these individually. So starting with your balance fund, this is your balanced portfolio where I believe most of your churches are invested. So it's about a little under $50 million as of the end of September. Throughout the years, we've changed this allocation. I guess we've changed it one time. The other fund is what we've changed a few times. This fund historically had been invested in our multiple asset fund. And that is what we refer to as our flagship balanced portfolio that has 65% equities, 35% fixed income. Well, just this last October, we made the decision to adjust this allocation where we removed our inflation protection fund and we also lowered international equities from 30% to 20%. And we added in the US equity index fund as part of this offering. So when the change was made last October, it had a positive impact. I mean, so this new allocation outperformed the multiple asset fund because mega caps, the top 57 or even 7 names, were up about 15% in that fourth quarter. So your portfolio was more overweight those names than what the multiple asset was last year. And also international stocks last year were down about 7 to 8%. So lowering that allocation and adding in that index fund really had a positive impact on your allocation. 2025 was a little bit different. What we saw in 2025 was that international stocks really picked up speed in February. So lowering that allocation and increasing US did have a negative impact. And this is when I'm comparing it to the multiple asset fund, the prior investment. So it did detract year to date. But in the third quarter, as Neil's going to showcase here in a moment, is that we did see mega caps pick up steam and international pull back again. So the lower allocation international, higher allocation to those mega caps definitely positively contributed in the third quarter. I do always want to remind you that when we made the change to this, it is for the long term. I just want to give you a little bit of an update of what's transpired, since we made the change roughly a year ago. But again, we want to position this portfolio for the long run and also make sure that Dustin and Tyler are putting forth a portfolio to your current investors and your prospective investors that more aligns with how they want to invest, which is one of the other reasons we lowered international and increased the index exposure as well to this portfolio. Dustin, anything you want to add to that I might have missed or did not cover?
I don't think so. That sounds good. Thank you.
Okay. Anyone have any questions? I know this is your largest portfolio, so I always want to spend a little bit more time on this than the other accounts, but happy to go back to it. So this is your fixed income portfolio. This is invested 100% in the fixed income fund. It's always been invested in this fixed income portfolio. And then Connie will talk a little bit more about the performance, but you can see it's had really strong performance over the long term since you invested in November of 2019. This is your equity fund. This is a fund where we have adjusted the allocation over time on it. Initially, when you invested with Wespath, this account had a 45% allocation to international and 55% allocation to US. We also did not have the index fund as part of it. So it was purely our primarily active funds that made this up. In October of 2022, we started lowering the international from 45 to 30%, and then we added in the index fund, about a 20% allocation. And then we did one final thing. So when we did the balanced fund reallocation, we also did the reallocation for this portfolio in October of 2024, where it's now so we increased the index fund to 30. The U.S. equity fund it stayed roughly at 40. I think we lowered it about 5%, and then we lowered the international a little bit further here. So you can see year to date, I mean, the fund has done well, primarily because of the index fund. My computer, does it look like it's jumping a little bit for you guys?
Yes,
okay.
Alive.
I don't know what's going on, but okay. So you can see the performance of this portfolio, and I'm on the index fund here. Any questions about these changes? Dustin, have you gotten any feedback from your investors regarding the changes that we made?
No, I think the few that have been nuanced in their bias to less international and more large cap have appreciated the move we've made, and then seem to be more okay with having. We are offering more international than they're used to, but that was welcomed this year, and
of course it was.
Yeah, obviously. So helping them understand we're 30% international, and so if they want less than that, we can use the U.S. equity index fund to make a change. So thank you.
And then this is the equity index fund. Again, we offer this as a standalone fund at the foundation. Again, for those investors that maybe want a little bit more US, maybe a little bit more of that mega cap, large cap exposure than what our current US equity fund offers. So again, you can see pretty, pretty competitive returns. Again, we would expect this fund to return in line with the benchmark. The difference between the benchmark and this fund is, one, we're showing fees. And then two is the benchmark does not include, as well as the benchmark does include, and the fund does not include, alcohol, tobacco, gambling, adult entertainment, and private prison stocks. So those are in the benchmark. They are not in our portfolio. And then the short-term investment fund. This is a fund that is part of the foundation's overall short-term investment portfolio. So this is just a little bit of a sleeve of a pool that is sort of managed by the foundation and outside of Wespath. And then looking at your year-to-date financial reconciliation, you can see which showcases contributions, withdrawals. This also what kind of pops up here, which we're working on, is also if you rebalance, it's going to show a contribution or withdrawal in each of those. But really the main focus is this capital appreciation. So all in all, with your investments, you've earned about $7.7 million so far for the first 3 quarters. And this is just, again, pure investments. It's not based on deposits or withdrawals, pure investments. This is what you've made. Any questions? Okay, I'll move right ahead. I'll talk about the equity funds, and then Connie, I'll turn it over to you to kind of talk about, we do have attribution slides in here, but I figured we spend most of our time talking here on this slide because it does show the trailing returns of this portfolio, of the portfolios. So really starting with the US, the US equity fund, this fund is primarily actively managed in its current state. And one of the things when Wah and I and Neil came in the summer was talking about the changes we're making to this fund. So where we are currently with those changes, as you recall, is this fund previously had different passive strategies, had like a Russell Top 200, had a Russell 2500 value. It had what we called like a TRP BlackRock strategy as well. What we did was we took all those passive strategies and we consolidated them into a Russell 1000 strategy. So a pure large cap benchmark strategy. So that work has happened. It started, I think the transition was happening and then maybe it was finalized the beginning of October. Neil, am I getting that right? I think you probably know the details more than I do on it. So that's the work since we met that we've been working on, is consolidating all those passives into the Russell 1000. And that's been completed. Now the work that we're doing is implementing the new active managers within those various sleeves. And that work we anticipate will take the remainder of the next few months. So when we meet in January or February, I can't remember when the meeting is, we will provide an update to you on that work. But what's primarily been detracting, again, it's been that underweight to those mega caps, especially in the quarter, because again, we saw them sort of pick back up and return about 17%. So the underweight, did detract from it, as well as some of the active strategies within the portfolio. But again, this fund right now is sort of going through a transition period, which we hope will be completed by the beginning of next year for when we're reporting. Index fund, it performs in line with the benchmark, which is what we would expect. The International Equity Fund, this is a fund we're spending a little bit more time on. This fund is primarily actively managed. It's about 85% actively managed. So we rely heavily on the external investment managers that we are hiring to manage the portfolio on behalf of our investors. And one thing we've noticed, and I know Juan, I touched on this, is that our managers in the last year or so have become a little bit more correlated, which means there's a lot more overlap in their portfolio. So part of the work that Wa and her team are doing is understanding that overlap. What is the reasons that manager A is owning similar securities as manager B? So we're doing a lot of that work right now, is what we kind of refer to as the deep dive. The fund tends to lean a little bit more value, and value international stocks, unlike US, have done really well, where growth has pulled back. So again, we're doing some work on this international fund, but we did launch an index fund, which I'll talk about here in a moment. And Connie, I'll just turn it over to you or Miles if you want to talk about the fixed income strategy and kind of what's been contributing to the outperformance across all time periods.
Sure. Yeah, I'll talk about it here. And then some of the points I make, Miles will talk about a little bit later in the presentation, and he has a couple of slides that will be useful. But if you look at the fixed income strategy, the second fund from the bottom, and then kind of move your eyes across the page, I mean, those are remarkable returns out to 3 years. And then beyond that, the 5-year and 10-year returns that, recall prior to interest rates moving higher at the end of 2021 and 2022, they were very low. And you can look at a yield and just kind of assume that, oh, that's probably going to be pretty close to what the return will be, 5 years from now or so. And so we've had, yields moved higher, and we see that reflected in the performance. And additionally, the fund has outperformed the benchmark. And the way the fund is structured is underweight government and treasuries, and then overweight corporate bonds. There's exposure to global bonds, emerging market bonds, high yield bonds. There is exposure to non-dollar currencies, and all of those things have helped. So we're just in this time where it's been a little bit of a risk-on period, a lot of uncertainty, but still market participants like riskier products right now. And spreads have held in. So the difference in the yield between a treasury and a corporate bond is very low. And usually that's not a great thing. You want to get paid for taking more risk. However, the demand for those securities is high, and they've performed very well. When I look at excess returns on Bloomberg of all the different sectors of fixed income over treasuries, it's all green. Everything's added. And I'm spending a little bit of time on that. And over the long term, we expect to outperform, taking on a little bit more risk than the benchmark. But it's not always going to be the case in the short term. And so I just kind of want to manage expectations a little bit. The sub-advisors, the managers of the fund are all taking a little bit of a defensive posture right now. They expect that spreads may widen, meaning that the difference in yield between a treasury and a corporate bond might move higher. And when rates go higher, prices go down. And it's a time to take advantage. Oh, prices went down. Let's buy that now. They want to make sure they have an opportunity to take advantage of those situations. If we look at the 1-month return for the fixed income fund, it underperformed. And the reason it underperformed is because, in large part, because of the allocation to global bonds. And, there's reasons for that. But I just want to point that out. In the short term, we could underperform. And we have underperformed in the past, and you've lived through it. But over the long term, we should outperform. And then the short-term investment strategy at the bottom of the page, competitive with the 90-day benchmark. And the short-term investment strategy can go out, they can buy bonds out with 2-year maturities. And so it's been tough to beat that really short benchmark. I mean, we saw the inverted yield curve, and short yields were king for a while. And so the fact that this fund has kept up with the benchmark, over the last few years is great. Super high quality, very liquid fund. I'll pause there for questions. Otherwise, I'll turn it over to Karen or Neil.
I'll talk about this. Again, I mentioned a few times that we launched an international equity index fund. Again, this came out of demand from our clients wanting more of a passive strategy for both our US and non-US funds. So we did launch a international equity index fund that is benchmarked to the MSCI World ex-US. So one thing to just call out is it's not going to have that private market exposure that the international equity fund has. It also is not going to have emerging markets. Because we had some, when we were looking at a type of benchmark, we do believe it's beneficial to be actively managed in emerging markets. Also, some of the demand that we were getting was more of a developed market benchmark is what they were looking for. The fee is about half. International equities are more expensive. Therefore, the fees tend to be a little bit higher, especially with active management. So when we launch a passive product, we are able to lower the fees. And also, we do own the underlying securities of this benchmark. Because again, we want to make sure we're not investing in alcohol, tobacco, gambling, adult entertainment, and private prisons. And I did create an exhibit. I had one client that kind of asked is that they wanted to see what really the difference was in performance-wise. And I'm happy to share this with you afterwards, Dustin. So the blue bar is the current international equity fund. And then the gray bar is the index. It's purely the index. So the comparison we're using does include alcohol, tobacco, gambling, adult entertainment. So you can see over a quarter to date, is that the international equity fund did better because of emerging markets. So typically it's going to be that does EM do well, and the impact that that's going to have on the outperformance or underperformance of this particular benchmark. But you can see historically, the passive strategy has done better. Again, I can't say if it's always going to be this way, but this is, looking at a snapshot in time, the benchmark did do better than the active strategy. I'm open for discussion about this. Again, it is a benchmark. It was just launched in the beginning of October. I've had a few foundations that have added it to their portfolio as a complement to the current product. I've had one foundation that I think swapped out the active product for the index. So I would be open to hear if anyone's questions or comments about this portfolio.
I'm sorry, I misheard you. Is it screened?
Yes.
Exclusions are screened for this.
Yeah, it's this. What's on the slide? It does not. It does include the because we're just using the benchmark.
Yeah, but your new index fund will be screened, but it'll be passive. What will be different between it and the social values option is that it does not screen additionally for the fossil fuel things that fund has.
Correct. And then also the social values fund does include US. So that's more of a global equity. This is purely international.
Okay. And then is the weighting to cap size matching how do the cap
it should be, it will be the same. So we're not the reason the cap sizes are different, and I can send you that information of what it is, but it will be in line with the benchmark. The reason we would be different is if we do deploy active management. And so this is purely passive, very similar to the US equity index fund. You are owning the cap sizes of what's in the benchmark. So there's no underweighting value or growth or anything like that.
Okay. But in the active one that we currently use, there is underweighting to value growth or to cap size?
Let's look here. I have it right here. I don't have it based on cap size. I can send you a screenshot of that, but we are, like I said, modestly overweight value. And again, that's an unintended overweight that it's purely based on the manager's security selection that we've hired them. But there is no, our international equity fund, the only strategic bias we have is we are overweight private equity and private real estate. Otherwise, we are fairly, we no longer have an overweight to emerging markets. we don't have an intended bias towards growth. It's just the underlying managers tend to drift more towards value, which has been a hindrance on the portfolio.
Very good. Thank you.
Okay, perfect. Neil, I think I'm turning it over to you here.
Yeah, that sounds good.
Correct me if I'm wrong.
Yeah, this sounds perfect. Thanks, Karen, and great to see everyone again. So slide 17 here, I think this is a slightly different iteration than you all are used to seeing in past quarters. So think of this as we're looking at the fund allocations for the U.S. equity fund versus both its benchmark, but then also the U.S. equity index fund, given that's now a component in several of your investment accounts. So looking here, you'll see the mega caps. That's our largest strategic bias. So we're going to see that underweight of about 23% versus benchmark. That underweight is offset by those overweights in small and mid cap stocks at about 16% and an off benchmark allocation to private equity and private real estate of about 7%. So this has been a way for you all to see, well, adding that passive US equity fund into your portfolios, that was a way to get a little more of that mega cap exposure, as Karen has alluded to earlier in the presentation. Really buying some time there for changes to be made in the actively managed counterpart in the US equity fund. But just a reminder here that this comes into play with your Kansas Balance Fund, which is 26% allocated to US EF, 21% allocation to and Karen, you could go back for just 1 second, and just a 21% allocation to the passive fund. Your Kansas Equity Fund, just a reminder that 40% is allocated to US EF, slightly less at 31% to the US Equity Index Fund. And then, of course, you all have the Kansas Equity Index Fund with that 100% allocation to passive US equities.
Neil?
Yep.
I think last time we had a column as to what our allocation would look like based on our combination of active and index fund on this slide or some slide. I would like to have that every quarter as a standard report. Do you recall that? I think it was something Dustin had worked up.
I had worked up, and I failed. Karen asked me about that, and I failed to remember that we had presented it here. I thought it was just to one of my churches that I was presenting their unique mix. So that's my fault for misunderstanding. But I think I'm happy to visit with Karen about getting that next time.
Yeah, sorry, Richard. I saw that in the report, and I reached out to Dustin about it. I think we failed to remember that was a request from you, and we thought it was something that Church of Resurrection just wanted for their part. But yeah, happy to add it back in.
Okay, I think it's interesting. We ought to know what ours is that we're offering, and not just the standard product since we made changes.
Thanks, Richard. I've taken a note there, and I did notice that was included last quarter. Personally, I thought that was a one-time ask, but happy to start we're more than happy to start including that going forward, though.
Okay, I think we need to see it all the time since we've made changes.
That sounds great.
Okay, thank you.
Mm-hmm. All right, slide 18 here.
Maybe we'll just go to the international, because I do want to be mindful of time, and I do want to give Connie and them, because I know we talked about the attribution during the other comments, Neil. So maybe we'll just talk about international equity fund.
Sure. All right, so looking at allocations for IEF, we're not going to see any of those large strategic tilts like we saw in the US equity fund. The largest off-benchmark allocation here is that 6% allocation to private equity and private real estate, and that is funded by very modest underweights to developed markets, emerging and frontier markets, as well as REITs. All right.
Connie, I'll turn it over to you if you want to talk a little bit about the fixed income, or Miles. And whoever wants to kind of talk about the construction, I know we talked a lot about what contributed and detracted of it, but happy to take your lead, Connie and Miles.
Yeah, so this is reflective of comments I made earlier when we talked about performance. You'll see if you look at the upper right, negative 38%, that's US Treasuries and government allocation versus the benchmark. So very low allocation to government and Treasury and agency bonds. And then an overweight to other sectors of the fixed income market. And I think what's important here is the way we think about constructing the fund is we want to allocate across return driver opportunities. So we want to allocate across regions, across sectors, across industries, across maturities and durations, to a limited degree across currencies. And that's what's reflected here. And when we think about that, we like that. We think it's a good idea. And it also helps to diversify the risks. So if something goes haywire in one arena, we still have all these other pockets of exposures that, will hopefully hold up. So any questions on that page? Otherwise, we can move on, Karen.
Yeah, great. Is there any question, Connie, maybe just a few comments. Is there any work that you're doing in the fixed income portfolio now? I know we spent a lot of time talking about the equity portfolios. Just a reminder to everybody, I mean, we have spent a lot of time on the equity funds, but we are always doing this like daily due diligence and work. I mean, we have an internal investment committee. We're constantly doing deep dives on the funds, talking about managers, sectors. This was something that Jahara brought on when she started 2 years ago. So maybe, Connie, if there's just a few comments to make of the work that you're doing within the fund.
Yeah, I would say there's a couple of levels of work that we're doing. And the fixed income funds are fine. They work over the long term, but things can always be better. So a couple of things that we're working on is finding bench managers. So what does that mean? That means that if something happens with one of our managers where we're thinking about maybe replacing them, we have this group of managers that we've already diligenced, that we've already met a couple of times, that we have high conviction in that could possibly replace a manager. That's not to say that we wouldn't go to a full search, but we do have kind of our favorites that we would possibly use. And then at a larger scale, we look at the construction of the fund. And right now, the way the fixed income fund is constructed is called an anchor satellite strategy. So we have PIMCO as our anchor manager, and then these satellite managers who manage sleeves of high yield and a sleeve of emerging market debt, and then one of global bonds. And we think about, is that the best way? Over the long term, that works well, but other ways to construct a fund also work well by putting managers together who maybe manage to the same benchmark, but do things a little bit differently, have focus. Maybe one focuses on corporate debt, one focuses on securitized, one focuses on top down, bottom up. So we're looking at things like that. And again, that's not to say we would make a change, but we like to do this analysis and we like to always think about how can we make things better. And so those are kind of the two big things that Miles and I are working on. And then aside from that, just, under Johara's leadership, we've really taken a team approach to looking at fixed income. Our public markets team works very well together, get a lot of idea generation. And then, of course, we work with the broader team as well to vet ideas and enhance ideas. So I'd say that's kind of it. Yeah.
Thanks, Connie. I know you haven't been on and previously, so when they hear so much about equities, that I thought it would be helpful to kind of share a little bit about how we are thinking about our fixed income portfolios. Okay, Neil, I'll turn it over to you to talk a little bit about, let me pause. Is there any questions about performance, international index, fund construction, work we're doing before we move on and kind of close out the presentation with the market update? Okay, Neil, I will turn it over to you. Just tell me when to switch slides.
Yeah, and this is a pretty exciting slide to speak to. You all are not going to notice a return less than about 5% on the page here. Yes, they're short-term returns. We're looking at quarter to date and year to date, but still remarkable nonetheless, in the face of so many headwinds. I think about geopolitical tensions, policy uncertainty, tariff concerns, the labor market that's been weakening, and yet you're looking at these really resilient returns. So what drove the 8% return in the U.S. equity market during the quarter? Well, it was a continuation of the AI spending theme, of course. There's been a dovish Fed tone hinting at rate cuts. We got one in September. We just got one the other day, a few days ago in October. And expectations had been for a couple, maybe 2 to 3 more heading into the first half of 2026. We'll see if that's still the case, given Powell's comments yesterday that were a little bit differing from that. And mega caps, they performed really well. You're going to see that 18% return for the quarter. So they really performed well, but maybe not quite as strong as earlier quarters when they were single-handedly driving the U.S. equity markets. And then we also on this page, we look at the story of U.S. versus international equities. We zoom out to 2025 year to date. That gap between U.S. and international equities is about 11% in favor of international. That gap was as high as 15% a little bit earlier in the year. So we had 2 consecutive quarters of international outperforming U.S. in quarter 1 and quarter 2. We didn't quite get that 3rd consecutive quarter here in quarter 3, since U.S. outperformed international by about 125 basis points. And I bring that up because when we speak to institutional consultants, we've heard a story of wanting to see 3 consecutive quarters of international outperforming U.S. just to really solidify that theme and to show that it has legs and staying power. And why international over U.S.? Well, a lot to do with the weakening U.S. dollar, supportive policies and stimulus in Europe. And I think about supportive policies and flows into China in particular. China was up 21% over the quarter, and then attractive international valuations compared to U.S. stocks as well. Any questions there? There's a lot of good news to report here, despite all those headwinds that I mentioned. Okay, and slide 25 here is a visual representation of what's been happening to the U.S. dollar over the past year or so. So it really has been on quite a decline. So it's been down 10%, I believe, year to date through the end of quarter 3. Now the downward trajectory paused for a bit here in quarter 3. It was actually up 1%. But that is something we're going to be watching really closely and will directly impact this story of U.S. versus international stocks.
Connie, over to you. Or Connie, anything you want to add right here as it relates to like our fixed income portfolio? You know, you mentioned the dollar decline has been supportive of our non-dollar allocations. Yeah. Anything you want to add before I move on?
Yeah, I would say if we the performance for the quarter and year to date, emerging market debt has really helped performance. And part of that is the weaker dollar. Emerging markets tend to have, well, some of them have products that are like things that come from the earth, like metals and other components that are really helping to an important source for the AI boom that's going on right now. And they're priced in dollars. So when the dollar goes down, those are cheaper. And so that's very supportive of emerging markets. And I would say that's the only thing that I would add to Neil's comments.
Do you believe this trend is going to continue given the
like the Fed, what they just did, the lowering of the rates and tariffs?
I'm thinking more about the debt of the country and figuring out how to get out of that, and inflating in devaluing the dollar and adding more money supply, maybe the primary route out, if there is an out. So
Yeah, I think
that plays into
that's a real possibility, Dustin, that this will continue. The dollar's still overvalued versus other currencies. When you look at things like debt and country level debt, and then countries, Neil mentioned geopolitics. Other central banks around the world, developed and developing central banks, are looking to have more of a diversified basket of safe haven currencies and gold, versus just holding the dollar. The dollar, it is the safe haven currency, and that will not likely change, but this kind of diversifying away from the dollar will continue. So yeah, I think that's right. And our sub-advisors talk about making sure that they take advantage of other opportunities that are, non-dollar opportunities, and making sure that they're exposed to those in the portfolio because of what you just mentioned.
Thank you.
I know Neil said the equity returns were exciting. I'm excited to talk about this.
Me too.
Fixed income's had strong returns in 2025. And most of my comments will be year to date. And really at the top line with commodities, it's been super interesting with the surge of gold and silver prices over the year. And to Neil's point about uncertainties, that's been a common theme that we were hearing this year, starting in early 2025 with tariffs in April, and coming out of that, you also have geopolitical risks around the world that have been sort of static over the last few years. And just the economic uncertainties of the implications of tariffs on inflation in the US. There's been a lot of factors, and that's driving investors towards some of these more safe haven assets like gold and silver. Gold and silver make up over 20% of the Bloomberg Commodity Index. And so you're seeing institutional investors, retail investors, and even central banks moving away from the dollar and moving more into safe haven assets like gold and silver. Silver has also been buoyed by the fact that there's this industrial consumption demand driver. Silver is a critical component in electronics, solar panels, and data centers. And data centers particularly of importance given the rise in AI capex spending. Connie also mentioned with the global ag strong returns year to date. A lot of that's one of the things that we're hearing from our sub-advisors is this theme of global diversification. There's this abundance of opportunities in the global fixed income set outside of the US. So that's been impactful as well. And then with corporates, both IG and high yield spreads started the year tight. They widened after the April tariff volatility, but have since come down and are back below end of 2024 tights. Yet still fundamentals are strong, defaults are low, qualities there, and the demand for corporate bonds has been strong throughout the year. Karen, just on timing, how much time do I have?
Yeah, maybe like 5 more minutes,
Okay.
and then we'll open it up for questions.
Sounds good.
Does that work with you, Dustin? Okay.
And then lastly on this slide, looking at the bottom, the U.S. Treasury Index has lagged. So these other broader fixed income indexes only returning 5.4% year to date, and that's due to a combination of this increased economic policy uncertainty and the inflationary pressures. And really through the first 9 months of the year, it's like, where is the Fed going? How much will they ease and cut rates, if at all? If you move on to the next slide, it's remarkable how fast things change. This is as of 9:30, but we had the Federal Reserve meeting yesterday where they cut rates by 25 basis points. And I think the market and the FOMC were expecting a more substantial cut. either in this period or in the December meeting. But some of the comments coming out of yesterday's meeting were painted more of a cloudy picture, I guess. And one thing driving that is due to the government shutdown, we're seeing a lot of the data that the Fed and our sub-advisors are using to track economic data, including labor market and inflation, has been lagged. And there's been this sort of data blackout, which is really clouding the picture for the FOMC and making it harder for them to have confidence in lowering rates.
Yeah, I found that interesting. I read an article about that, how, because there's like what impacts the government shutdown's having. And it's actually on these bureaus that are providing data for investors and the Fed and other policymakers to make these decisions, which is something that I was, not that I wasn't aware of, but it wasn't at the front of my mind of what part of this impact could do. So it could be like, again, this black hole of like, how are we making decisions without the data? And the Fed said it's going to be very data-driven decisions. So it is interesting.
And one of the things we're hearing from our sub-advisors, they use alternative sources of data in their investment process, and they have historically.
Like I heard ADP, sometimes they can get data from ADP regarding like payrolls, but again, it's only like a subset because like not everyone uses ADP. So it's only the ADP subscribers. Again, all new to me. And Neil, you went off mute. Something to add?
I think it's less than 20%, that ADP accounts for.
Yeah. Thank you, Neil. Look at that.
Yeah.
But yeah, interesting. Just a lot of stuff you didn't think about.
And I guess if we could go back actually just to wrap up on Fed funds rate expectations. So coming out of yesterday, I think going forward, we have another meeting in December. It's the last meeting of the year. I think the market was pricing in roughly 35 to 40 basis points of a cut. Coming out of yesterday, I think that at most will be 25. The market, as of last night, was pricing in a 67% chance of a 25 basis point cut in December and a 33% chance of no cut in December. And actually, yesterday the decision was really interesting, and it was I don't know if this was the first time it happened, but you had two dissents. Typically, the Fed, when they vote in unison together. But yesterday there were two dissents. One dissent was in favor of no rate cut for yesterday's meeting, and one dissent was in favor of a 50 basis point rate cut. So you're seeing really differences within members of the voting committee there too.
Thanks, Miles.
I can talk briefly about this slide, and this is just a little bit of walking down memory lane and then kind of where we're at right now. So if you look at, the period of like July, 2020, January 2021, inflation was still, and then July 21, inflation was pretty tempered, but at the time there was just a ton of money getting dumped into the system. And recall that the savings rate was super high. So people weren't spending yet because they really couldn't. And then, moving in, we see this, the CPI inflation just really start to spike up as people were spending all that money, moving savings down and money going out into the system and putting pressure on prices. And the Fed lagged a little bit in when they started to increase rates. So inflation got as high as over 9%, which is, super high. And then as the money starts to work through the system, now prices have come down, although they're still well above the 2% long-term target rate. And so, the Fed has started to lower rates from over 4% to where we're at now. And we'll see what happens next. They're in a tough spot. The jobs numbers are a little bit weak. And remember, the Fed has two jobs, and that's to have full employment and to keep prices under control. And so we're in a bit of a situation now where the jobs market is weakening. We're seeing layoffs in the news. We're not getting the numbers reported to us from the federal government, but we're seeing news reports. And then, we're also seeing that inflation is closer to 3% than 2%. So yeah, a little bit of a tricky spot that the Fed is in, and we'll see what happens. It'll be interesting to see what happens.
And then this is just kind of the final chart that kind of brings in all the equity and the fixed income data. This shows the asset class returns, the best and the worst through each of the last, going back to 2010. And I always just like to point out, what's been a leader one year is sometimes a laggard the next year, which is why it really benefits to have this diversification. And then the mid, kind of a 60-40 portfolio is here in the middle. Because again, looking at emerging markets, one of the best year-to-date asset classes, and then obviously have been at the bottom over the last years prior. So again, we don't like to time the markets. When we make decisions in portfolios, we want to be strategic and we want to be long-term about those changes. But yeah, that's all we had prepared. Again, thank you for your time and happy to answer any questions that you all have.
Tell me about the thought process that some of the other foundations done with regard to the international. I see if we made the change, like you said somebody else did, it would reduce our fee for that portion of our fund by half from 672 to 36, or I think that's roughly there.
Yeah, roughly around right. Yeah.
Also, so the private
and the emerging markets. So I think that is why some of the foundation partners have chose to remain with the international equity fund, just again, still kind of get that active management component, that emerging markets. But then, obviously, wanted to get some of that passive exposure, market exposure. So for instance, your international equity allocation and your equity fund, would go from 30 to 15%, if we wanted to sort of split it like we're doing in the US. And then, here we could do 10% in the balanced fund. Again, it's a very easy process to go through. We've worked closely with Gloria and Dustin when we've done it before. So the trades are made on the same day, but this is what we've been kind of the thought process some of our foundation partners are going through.
Thank you.
I wouldn't mind skipping back to page 17. I guess my question is, through all your review with management changes at the organization, is this allocation also going to be part of the review, or what can we expect here?
So what you will expect here, Richard, is this mega cap. The fund allocation is about 30%. You will see this go up. So likely in the first quarter, we're going to see this mega cap allocation go up as we're making some of those changes to the managers, and we're decreasing this exposure as well. So right now we're about 16% overweight small and mid. Long term, we want to be about 5% overweight here. So right now is when the team is in the process of making those transition and changes. So this is primarily the difference that you will see is the mega cap will go up and this small cap will go down. The private markets will stay the same. We're not selling any in the secondaries or so forth. But, these two buckets will be where you'll see those changes. Likely when we meet in January.
Okay, I think it's an important move, and I know that's been one of the committee's concerns why we made a lot of changes to the index fund, as the committee was concerned about that.
The overweight.
Extreme over-under allocation. So that's good that that's being looked at.
Yeah, we're making the change. We're also adding in an opportunistic sleeve within the U.S. equity fund. Jahar and Wa brought a lot of great ideas, to the table, and we use a lot of thought, it's a big thought process, and Driven by, again, very similar to the Fed, driven by the data and the research that's being done, trying not to focus too much on past performance, but, how do we want to be strategically invested over the long term? And that's where a lot of this is getting driven from.
And by opportunistic, it's managers that can go anywhere. I think there's 8% allocation to a manager that can go anywhere.
Yeah, that's Seven Bergen. This would be like a long only strategy, maybe a tad like a hedge fund, but not a hedge fund, where it can kind of make moves in the market, be opportunistic where they see opportunity, where it's not like we're holding them to these constraints, but they have a little bit more wiggle room to kind of go in and out of where they see the market going in the portfolio. And again, something that we're going to be more managing in-house of those allocations to those managers.
Okay. Sounds like good moves. Thank you.
Thanks, Richard. Got your stamp of approval. I will let everyone know.
Yeah.
I like the direction.
And typically what I kind of envision is, this is some feedback we got from some clients, which we'll make sure is like maybe in the beginning of the presentation, we'll do like the work that's been done, kind of like start off with an update before we kind of dive into the accounts. But that's kind of what we'll be seeing going forward on the presentation.
And if there's able to kind of the issues about active, passive, and the asset allocations, I think that because you're going to be using more passive in the active fund. So it may, if you give some detail of that, it may cause us to say we could stop having two funds and go back all to the U.S. equity fund because
lower it.
Yeah. So very good.
Yeah. So we are increasing the passive in U.S. not by a lot, just 5%, and then consolidating it into large cap. So
Wonderful.
Well, thank you so much. If there's no other questions, we truly appreciate the partnership that we have with the Kansas Methodist Foundation. And again, we are here if you need anything. And we look forward to the next update that we have next year. So happy Thanksgiving. If I don't talk to anybody, a Merry Christmas, which is crazy to say, even though there's Christmas decorations at Costco already, and I just don't think I'm ready for it. So trying to avoid it.
Thank you all, and good to see the new ones with us, Connie and Miles. So thank you.
Yeah, thank you. Enjoy the rest
Good
of
to
your
see
meeting.
everyone.
Thank you.